the capital markets department is not, in and of itself, directly related to a lot of the functions we do as a mortgage bank. A lot of the things we do are more related to the bond market and the money markets. Use of money, how the company deploys its money, how the company acquires and sells assets, securities, as well as whole loans, how we get involved with others in the business that we do as it relates to the deployment of money and buying and selling of mortgage assets. So even though there's a part of the capital markets department that kind of looks like the secondary marketing department in the residential company, which I'm sure a lot of you all are familiar with, where they're taking the mortgages that the company produces and selling those mortgages to investors or to Wall Street, we have an additional piece, which is investment. But we'll get into that. Most of the people that we have in the department are not real estate people. Most of them are bond market people. And that's because the people we deal with are in the bond market for the most part. And the real estate people that we deal with for the most part are here in the company. We have an in-house real estate expertise, which we'll talk about, but you'll see as we go through this organizational chart, the way we're set up is not really real estate oriented. The interface that we have as a department with servicing is on the acquisitions of servicing, where when the company buys existing servicing, it's our job to go get it. And you all know Kathy Marquardt and her gang, who is pricing that servicing. Well, a lot of what she prices we find. I think that's probably the chief place where we touch as departments. That and making sure that the contracts that we put into place with investors are suitable to you all, that you can service what we promise to investors. I guess a good example of that is the wrestling match we've been having over these adjustable rate mortgages. I know you all have been saying that all these adjustable rate mortgages we service, some guy has like the third Tuesday of September as his adjustment date, and we got to stop doing all that, and let's see if we can standardize. Well, that's kind of part of what we'll be involved in, that making sure that that standardization that you all seek to be efficient is part of what we're representing to investors. Okay, let's go through this chart a little bit. Now, what I want to do is talk about what each component of the department does and see if that gives some clarification to what we're doing in capital markets. Except for my assistant, there are 5 people that report to me. And starting from the left, Kathy Stilson runs our hedging department and our operations department. And what is that? Well, Kathy does in the markets, she's responsible for selling the Ginnie Maes that the company makes, the Fannie Maes, those are the negotiated Fannies and the DUS pools that we make, like those Aimco pools, those big pools. When we sell those to Wall Street, Kathy's the one, along with Mark Persicati, that sells those securities to Wall Street. All the Ginnie Maes that we produce, in 1995 we produced 159 million, and this year we're going to go over 300 million of production of Ginnie Maes. So we've doubled the amount of Ginnie Maes we produce in 2 years. Kathy's group sells those, and we've sold those in groups because of having the parent we have, GMAC. We have the luxury of being able to add loans up, putting them on the balance sheet until we get a bunch of them. And when we sell them in bunches, we get more money than we do for them one at a time. So Kathy's been able to take advantage of that. But the point is, she sells those Ginnie Maes to Wall Street. So when they come out of the system and they're funded, she's working with Wall Street investors and private investors to sell those Ginnie Maes. The other thing Kathy's group does in the markets is she protects the value of the conduit mortgages that we produce, the ones that go into the securities that we've been generating. Kathy's job is to protect the value of those mortgages on behalf of the company. So what does she do? Well, what she does is she calls on Wall Street guys, and she will sell Treasury securities. So what she's doing is selling short Treasury securities against the loans as we fund them. So as a loan gets funded, Kathy's doing a trade to protect the value of those mortgages. So that's her job. Once the loan gets funded, Kathy's job is to make sure that loan stays worth what it is until we get to the securitization. She has a whole team of people who form our operations department, whose job is to manage the processes associated with conveying loans in Ginnie Mae and Fannie Mae form to investors, as well as managing the day-to-day operation of the hedge position. And we call the treasuries that we trade the hedge position. Why? Because we're hedging the value of the conduit loans that are generated up in New York. And it's gotten to be a bigger and bigger job. When we started out, we had a little dinky $30 million, $40 million position of treasuries, and now it's over $800 million and growing as fast as the folks up in New York, the conduit people, can generate loans, is as fast as we're building that position to protect the value of those loans. When the day comes when we do a securitization, that's a big day for Kathy, because on that day, she's going to have to, we take those loans and they go to the underwriter of the security. And she, at that point, we convey the value of those loans into the security, and she has to undo that hedge. So in one day, at one time, she may be trading $400 or $500 million worth of Treasury securities. So that's like a total wired, crazy, maniacal. One mistake and it's a bad thing, because what's 1/32 worth per $1 million of mortgage? It's $312.50, right? So, and you guys know the tolerances we work in. So, one mess up, 1/32 mess up is 500 times $312.50. So what's that? Is that $15,000 or $150,000? Whatever it is, it's a lot of money. So she's got to be totally accurate. She's got to convey information from us to the Wall Street guys, receive it in a proper fashion, and coordinate her team. And that's why we have that trading desk, so that we can all stand up and scream at each other. And we all hear the same thing at the same time. Because what we do on these trades is we get all our guys on the phone together, and it's sort of a ready, set, go. And then we tell them to bid or to offer us securities. And then we all have to hear, and there has to be a quarterback who hears what everyone has to say, and then he says, okay, you do the trade. And the other people have to hear that, and you can't mess up. Because if two people do it, oh no, now we got to unwind. Because the convention in the securities market is if you tell someone, you're done. That's it. Now you've committed to a transaction. You're only as good as your word in that market, and we stand up to our word. So you can't have a mess up. Not only do you look goofy, like you don't know what you're doing, unprofessional, but it costs us money. So at the trading desk environment, where everyone can stand up and see and hear, and whoever's playing the quarterback can tell all the other people, you do the trade. They all hear it, and they can tell the Wall Street house that they're talking to, sorry, we did the business with someone else. So that's the purpose of that environment. When we get into these high-speed situations, we can protect ourselves by making sure we all have the same information at the same time. Having done that trade, that's when Marguerite Reyes and her gang kick in. They're the ones that make sure that accounting is involved. They know what we're doing. The people on Wall Street, our counterparty, knows what we're doing. They calculate accrued interest. They're working with, if there's a custodian, they're working with the custodian. They're doing all the stuff that's associated with making sure that these transactions happen efficiently. Moving to the right, Victor Mistrowski. What Victor's going to do is Victor's going to invest in the short-term market on behalf of the company. And there are a couple of places Victor's going to get money to invest in the short-term market. You all know that many of our mortgagors have escrow accounts with company. Some of those escrow accounts don't allow us discretion as to what we do with the escrows. I mean, they got to be put in treasury bills, and if we make any incremental money on those investments, we got to give it to the borrower, and the money's got to be segregated, and we can't play around. But there are other places where we can, and that's what Victor's job is going to be, to take, he's a professional, this guy is a professional money market portfolio manager. This is what he does. And his job is going to be to maximize the value of monies that will come from escrows. The other thing Victor's going to do is we have been asked by Dave Kramer to find external funding sources, warehouse lines. I mean, it's been nice for the last 3 years because we're the child of GM. We haven't had to go outside the house to fund our mortgages. We just call Mother GM and say, Mother, I need $100 million, and Mommy sends it. And that's been so lovely and easy for all of us because Mommy is rich.
That would be nice.
But we're starting to grow up a little bit, and it's time for us to find our own ways of funding our mortgages and to have external people who will allow us to have a warehouse line, which is a collateralized line by the loans we generate. And shoot, we're running at $500 million a month now. I mean, we're big enough to have our own warehouse line. Doesn't mean we don't love Mommy, but it means that we have our own places to fund stuff away from GMAC. So, Victor is going to manage those, help us manage those, because that's short-term money. I mean, a warehouse line, you put the loan in there for up to 6 months. It's financed at a floating rate. Things are going to be going in and going out. I mean, it looks like it's a short-term thing. Victor's a short-term guy. Victor's going to manage that for us. Now, Chuck's got an interesting job. Chuck's job is to invest money on behalf of the company, and he does it in several ways. When we participate in a security, a CMBS, we've always had partners. There's always been someone or someone's with us. For instance, in the September security, there's a whole gang with us. There was Conti again. They keep showing up. There was Lehman Brothers as an underwriter. There's Deutsche Bank. There was, shoot, who else? There's somebody else in there. I can't remember right now who it was. But there was a gang because it was such a humongous deal. Well, we combine all our mortgages, and then we go to the rating agencies, and then we, on Wall Street, who stratify the loans for investors. They take all of them, and then they turn it like this, and then they stratify it. This much is AAA, this much is AA, on down the line. So it goes AAA, AA, single A, triple B, double B, single B, and non-rated. And that's how they stratify. That's what they, AAA is the highest, non-rated is the lowest. AAA, AA, single A, triple B, double B, single B, non-rated, from top to bottom. Some investors only want the AAAs because they're the safest. Non-rateds are all the way down here. So what happens is, if there are losses in the pool, this guy, suppose a loan goes bad, Mr. Non-rated, sorry, it comes out of your investment. So he's making a big bet, so he gets the biggest return. Mr. AAA, up here, you gotta burn through all the money of all these investors all the way up to the AAA guy. So he's got all this stuff below him to protect him, so he gets the lowest return. But he's the most protected. So that's the trade-off. Well, and the nomenclature is, when someone says, is it an investment grade bond, what they're saying is it triple B or above? So they're saying, is it AAA, AA, single A, or triple B? That's the investment grade. double B, single B, non-rated, non-investment grade. Now you know that we have that gang out in San Francisco, the bunch of rocket scientists out there who can figure out any loan 7 ways to Sunday. They know the borrower, they know the real estate market, they know the history, they know the cash flows. It's their job to be able to work through loans that are subperforming or non-performing. Wait a minute. If these guys can do this in mortgages, if we make a security, can't we invest in the risky stuff? Because if it goes bad, we got the rocket scientists in San Francisco to figure it out. And by the way, it's our loans to begin with, for the most part. So Chuck's job is to buy, on behalf of the company, non-investment grade securities that come from our issuance, primarily, where we are the special servicer. That gets the geniuses in San Francisco involved because they're the special servicer. That's what they do. And then the other part is those securities are typically the toughest to sell. They're the riskiest. There are more and more people interested in them because we've been in a declining interest rate environment. And typically, if rates are coming down, stuff is getting cheaper, cash flows look good, you have fewer defaults. The risky securities, hey, I can take a chance on this. Why not? 10 years is like below 6%. What could happen? That's easy to say today, right? But what happens if rates start running back up and all of a sudden costs start going up and things get nasty? Well, it'll be a different environment. But today, things look good. So Chuck's job is to buy the non-rated securities where we are the special servicer, the master servicer. He does a couple other things too. We can buy closed loans, floating or fixed rate, that we can add to securities that are sold servicing released. It's his job to find those loans, and we have an objective next year of purchasing $1 billion worth of loans to add to the to add to the loans that are conduit eligible that New York is producing. He does a couple of other things too. He reports to senior management on that portfolio that he's generating. And he does that quarterly. He works through an investment committee, of which I'm a part. My boss, Charlie Dunleavy, Dave Kramer, Wayne Hoke, and to name a few who are on that investment committee. And its job is, if he finds a big investment, to examine it and to decide, is this something the company chooses to invest in or not invest in. So that's what Chuck does. Now, the cash flows on a lot of these securities are the aggregation of the cash flows from these individual loans. And they got to be all summed up and then sort of chopped up. Like, does Mr. AAA get all the principal and interest? What does Mr. Non-rated get? Can I mix and match this? Do I have to, does Mr. AAA get his pro rata share of each of the mortgages? Or do you do some sort of mixing and slicing and mix? And that's what Kara Rainville does for us. Her job is to run the modeling on the securities that Chuck buys and to be able to take loans that we generate and see what they look like in a security, to project forward what this is. Our whole job is adding value, right? We take loans from into securities, we make money for doing that. Kara, if we take our loans and we put them into a security, how much do we make? What are we doing? Are we making money? Kara's got this computer model we bought in New York from a company called TREP. She can run our loans through that model and examine that. Any other loan acquisitions we may make of closed loans, it's Kara's job to sort of set that up so we can see what it is. Give us a run. What's the weighted average coupon? What's the weighted average maturity? What's the biggest loan, lowest loan? Kara, set it up so we can see what's coming in. And that's Kara Rainville. Avis is, she's a professional underwriter. And she has a team, Parker Heckner, Dave Rosen, and Allison, who give us the ability to find loans, turn to Avis and say, Avis, good loan, bad loan, do we like this as a company? Chuck can do the pricing. We know where it's going to trade in the market. We got the market thing working. We can do whatever we want with the information. We got Kara But what we need and have now in Avis is the ability to say, this is a solidly underwritten loan, it's an investment the company should make, it looks like it makes sense, let's go. Go, go, go. So her job, suppose some loans come in that are servicing released from some guy on Wall Street, he calls up and says, hey, Phil, I got $50 million a loan, servicing release. My guy wants to sell them. Do you care? I'd say get the information to Kara so Kara can set it up so we can see what it is. Kara's going to do a run in our standard format so we can see what it looks like. Stack the loans up. Where are they? What states? Are they all in Texas? You know, geez, no, I got a couple in New Jersey, a couple in Pennsylvania. We'll set it up from the biggest state so we can kind of see what are the coupons, how do they go? Are these things going to be over par or under par? Kara set it up so we can see. And then she'll give that information to Avis. Avis will then get the real estate file and say, oh, no, look at this. This thing was underwritten by the Three Stooges. We don't want this thing. Or she'll say, this looks fantastic. This, from a real estate perspective, this is lovely. I'm so happy. And then what they do is they take that information to Chuck. And Chuck's job is to deploy the company's money. No one can spend the company's money on the trading desk except for Chuck. That's his job. Chuck, then they go to Chuck and they say, Chuck, this looks good, man. You may want to do this. And then Chuck's job is to put a price on it that gets the asset for us. So that's how our team works.